Hi, Sam Rowe here, Portfolio Specialist from T. Rowe Price, summarising another week in markets for the week ended 1st of May. Global markets closed slightly higher last week, up a little more than 1%, and we've seen volatility much more subdued now for around 3 weeks in a row. The activity we saw in markets last week was really centred around negative data mixed with band-aids and hope. And we think about this negative data, a lot of what we're getting at the moment is actually out of the US, and we've seen around 70% of their corporates report earnings now. Last week we had some of the largest ones such as Apple, Amazon and Facebook report earnings. And broadly, when we think about how bad this has been, earnings for the US market have been negative, but very slightly not as bad as what the market expected. The uncertainty, however, is certainly still there, and this was highlighted by Apple, who didn't give next quarter guidance, and this is the first time they've done this in around a decade. When we think about negative data, this was met by more band-aids in the US, with the Federal Reserve announcing as much stimulus again as it takes, really reinforcing that they'll do whatever they need to do to get the economy to the other side. The market started to digest this, but then really turned back to the hope, and this was a hope around how we get to the other side of a coronavirus. There were some positive announcements as we saw more countries begin to ease their lockdowns. We had Donald Trump announce Operation Warp Speed, which is about fast-tracking a vaccine. And then we also had more positive test results on this therapeutic drug, which is called remdesivir. How we got through this period was very, very positive through the week, but this was very quickly disjointed by more negative rhetoric coming out of the US in terms of China-US relations. And this is something that we're going to be monitoring very, very closely and expect to actually pick up as we head into a November election. How the market reacted at the sector level and the country level was really a return to cyclicals last week. And we saw some of the sectors, but also regions that have been laggards versus the US particularly, start to recover some ground. So last week we had regions such as emerging markets and also Europe really outperforming the US as people started to find some value opportunities. The portfolio performed very strongly versus its benchmark in April and continues the strong outperformance we've had in 2020 so far. When we think about this, there's really 3 stages we've seen this year. We've had pre-coronavirus in January, we had the market sell-off as the world figured out how bad this virus was, and then the recovery, which has been quite extreme on the other side since the 23rd of March. The portfolio's managed to outperform in each 3 of these phases, and that's really because we've been quite active throughout this period. We did call very early that we thought that we may well have seen the bottom of the market in February, and that's because we had a more positive view on how prolonged and how fast this virus would spread around the world. We added more risk into the portfolio at that point. One of the biggest additions has actually been to financials, which was a large underweight coming into this period. But then since then, we've reduced consumer staples as well. When we think about how to replace the reduction in consumer staples, it's not in any name that's been beaten down. In fact, we've actually taken out some names where we don't think we have any edge or insight, such as the aerospace, particularly Airbus and Boeing. But we're adding to names now where we feel we have some insight in terms of how they recover, whether it be consumer discretionary retail, for example, as the world starts to get back to normal.